company during a period based on various transactions and events related to non-owner sources. So we're not dealing with the stock, the common or the preferred stock. We're dealing with equity changes not related to stock, but related to other reasons. So we know that we have earned capital and we also have contributed capital. Contributed capital is that money that was given to us by shareholders. Earned capital comes in from our net earnings, minus any dividends we pay off, plus other forms of income. Includes changes in the value of shareholders' equity resulting from transactions, events, and circumstances that are measured and reported in net income, the reason they're in the business, and changes in the values of certain types of assets and liabilities that get reported in what's called OCI. We've been talking about it, now we're going to look at other comprehensive income. So we know comprehensive income isn't just about the net income, the reason the company's in business. It's about any changes in the non-owner portion of the equity section. Accrual accounting, we should all know, economic events get recorded not when the money comes in or the money goes out, but when the events occur. Okay? So when revenue is earned, doesn't necessarily mean we've received it, but when we've completed the service, or in the case of merchandise, when we've shipped the merchandise, when the title transfers, we earn income. Make sense? It's not when we receive the cash. So basically, net income is going to equal revenues minus your expenses plus any gains minus losses. Okay? So we've added, in the past we know net income is revenues minus expenses. In this class, it's revenues minus expenses plus gains minus losses. Okay? I want you to know that. Don't worry about this paragraph of net income measures accomplishments. Net income equals revenues minus expenses plus gains minus losses. So now we're going to talk about these 4 aspects of an income statement. Revenues. What are revenues? Increases in assets or settlements of liabilities. So think about it. Increase in cash, increase in accounts receivable, right? Could be an increase in a building. Could have been an exchange for services performed. There are increases in assets, or we could have used those assets to reduce liabilities from delivering or producing goods, from rendering services, or other activities that are the company's ongoing major or central operations. Very important to know, revenues are why the company's in business. A CPA firm provides services. If they sell the CPA firm, that would not be a revenue. Their main reason for being in business is to provide various services. Those are the revenues. Target. Target's reason for being in business is the sales of products. Okay? They may have other reasons they receive money, but that's not their revenue per se. Their revenue deals with the reason they're in business. Is basically they're a middleman and they're a merchandising company and they purchase product for customers to come in and buy. That's why they're in business. There might be other aspects, but revenues are the sales from those products. Make sense? They represent increases in future economic benefits from increases in cash, increases in accounts receivable, or other types of assets, or sometimes they can have revenues can be a reduction in liabilities. So there are times that instead of increasing an asset, it's possible that as a result of that transaction, a liability is forgiven or reduced. It's the same concept. Obligations to customers who have paid in advance for goods and services. They measure the accomplishments of the operating activities in producing and delivering goods or services to customers. So again, depending on what company it is going to vary what type of revenue is normal for that company. Now, we know the revenue recognition principle is basically revenue is recognized when A, it's been earned, and B, when we think we're going to receive the money, when we feel reasonably certain we're going to receive the money. I don't know if I told this class or another class, but I had a client who was a commercial painter. And he comes to pick up his tax return. I knew he was going bankrupt. But most people, if they want you to do a tax return, they're going to have money for you. Well, as this guy's picking up the tax return, he says, you know, you're not going to get paid. Now, I should have said, you're not going to get your tax return. But did I? No. That was 10 years ago. I've gotten smarter. So, would I record that as revenue? Probably not. I did complete the job. I handed it to him. But is the collection of that money reasonably certain? No. So technically, it would not have been revenue in my books. Because he basically told me he's not going to pay me. Make sense? So it needs to be both. It needs to have been earned, and there's got to be a reasonable certainty you're going to get the money from what you provided. So know those two pieces. That is key. This is interesting. A study by the SEC, Securities and Exchange Commission, indicated that overstating revenues and recognizing revenues too soon are involved in over half of the financial reporting frauds in the United States. I believe it. I hate to say it, but it's easy to do. You know, unless somebody really goes in and starts checking the books and seeing when was this shipped. Then they can see, wait, you reported this before you shipped it. Or when was this service completed? And they'll have their ways of being able to find out when the work was done. But do you understand what I'm saying? They just changed the dates there a little. Over half the frauds were due to overstating income because they're trying to boost up their profits. Okay. Revenue recognition related to cash flows. No, I'm not going to worry about that. We're not going to worry about that either. Let's talk about expenses. Expenses are outflows or the use of using up assets or incurring liabilities. So oftentimes we use up assets to pay bills or for costs. Sometimes we reduce our assets, not just cash, but because we have prepaids. And then oftentimes we have expenses that become a liability on our books until we pay them. Okay, so 3 different ways in which expenses occur on the financial statements. And they arise from outflows of using up cash or increasing our liabilities from delivering or producing goods, rendering services, or carrying out other activities that are the company's ongoing major or central operations. So with Target, they have salaries to pay, they have buildings to maintain. Those are expenses. If they go and purchase a tract of land for a potential future site, that's not an expense. It's going to be in another category. Do you see what I'm saying? That's really not the ongoing day-to-day operations. They may go and purchase another business. They may buy up all the Aldis in town, so they lose their competition. Is that the main reason they're in business? No. So guys, understand revenues and expenses primarily are related to the reason they're in business, the major source of why they're in business. Okay? Okay. Now, let's look at an asset or an expense. Which one is it? An expenditure is money that's flowed out. If an expenditure results in an economic resource that provides future benefits, it's going to be an asset. If an expenditure results in providing a good or service in the current period and does not create probable future benefits, it's going to be an expense. Expenses get used up. Assets will have future probable benefits. Did I tell you about WorldCom? Did I tell you that story how WorldCom misstated their financial statements? WorldCom actually was paying a lease to use some cables for under the ocean to communicate with other countries. That really was a lease. They didn't own those cables. They had a monthly rent on them. However, they showed that expenditure as an asset on their books, not as an expense. Do you see how it overstated their balance sheet and it way overstated net income? Those lease payments were merely an expense to use those cables for that month. It really was an expense. When they found out that they were doing this, they went bankrupt immediately. Their stock, I mean, think about it. The assets are increasing at this exponential rate. Their income is high. And then when they have to correct their financial statements, all of a sudden, all these assets they said they have, they don't. And their net income became a loss. See what I'm saying? They should have shown it as an expense, used up in the period. They didn't. They tried to show it had a future benefit. How can companies get by with this? Because a lot of times transactions aren't so black and white. I'm making it real simple to you, but technically it really was a lease, a rent. But they tried to construct it as though it was a capital improvement. See what I'm saying?
Isn't there just like making payments on it? Or?
Somehow they were showing that this was going to provide a future benefit, but it wasn't because it wasn't even theirs.
They weren't ever going to own
Or at least no.
Maybe that was how they treated it, as though they were going to own it, but it was truly just a used up expense. Now let's talk about gains and losses. So guys, are we clear on what revenues and expenses are? Revenues and expenses have to do with the major reason that company's in business. Period. Okay?